Good afternoon, everyone. My name is Jordan, and I'm the co-founder of CRE Daily. And today we have a special webinar on the Midyear U.S. Multifamily Market Pulse. Today we're going to be joined by two very special guests, David Saxe and Brian Milovich, two of the founders and managing principals of real estate private equity firm Calvera Partners, which specializes in transformative multifamily investments, and they'll provide their unique perspectives on the commercial real estate market in general and the multifamily investment environment. Before we jump into that, I think I would like just to take an opportunity for Brian and Dave to introduce themselves, and then we'll get into our questions. So Brian, let's go ahead and start with you.
Thanks, Jordan. I'm Brian Milovich. I'm one of the co-founders of Calvera Partners. I'm located here in Minneapolis, Minnesota. Dave and our third partner, Brian Chuck, are located in San Francisco. From the office here in the Twin Cities, I'm growing the firm's staffing and have been kind of the key driver of pushing Calvera away from only investing in multifamily in the San Francisco Bay Area to more national deals, to now where we own in Texas, North Carolina, Minnesota, and throughout California.
Thanks, Brian. And Dave, how did you meet Brian and Chuck?
Yeah, thanks for having us. I just quickly on my background, I'm based in San Francisco. Focus a lot on company corporate marketing, investor relations, and fundraising from our San Francisco office where I'm talking to you today. To get started, so the three of us, Brian Milovich, Brian Chuck, who's not on this call, is the third managing principal, co-founder of Calvera, and myself, we all met while getting our MBAs at the Haas School of Business at UC Berkeley. I think Brian Milovich might have been my, quote unquote mentor, somebody that was assigned to me when I was a first year there, because he was graduated a year before both Brian, Chuck, and myself. We all were very heavily involved in the real estate program there. They have one of the top MBA real estate programs in the country. So heavily involved in things like the Berkeley Real Estate Club, case competitions, real estate classes, real estate networking, and all things real estate. While we were there, that's where we, all three of us met. Subsequently, or coincidentally or not coincidentally, we all ended up working at the same company after getting our MBAs. So we all worked for a $30 billion real estate institutional real estate manager. We did about $1 billion of deals, and we were all in acquisitions and asset management. Brian, Chuck, and myself were based in LA. And Brian Milovich was based in the Bay Area for CIM, which is the company that we worked for. We all were working at a big institutional manager called CIM Group, and Brian Milovich worked on a pretty interesting deal as part of his role at our previous company before we started our own company. And I'll turn it over to him to take the story from there in terms of what inspired him to have us all depart that company and start our own business.
Thanks, Dave. Well, the environment wasn't much different to what it is today. At our old company, I worked on a large distressed loan transaction where we ended up foreclosing on a large portfolio of rent-controlled apartments in San Francisco. That was really the inspiration for us deciding to go out on our own. I was meeting all the local brokers. The bite size of the deal was small enough for us to consider raising high net worth money for one-off transactions, and that was our goal at the outset, was finding distressed small rent-controlled apartment deals in San Francisco. Ultimately, we were unsuccessful trying to buy large portfolios with institutional partners, and the one-off deals were still pretty expensive in our opinion at the time. So we found a small 7-unit deal in unincorporated San Jose to get our feet wet, and then ran from there, buying larger assets across the Bay Area in places like Sunnyvale, Santa Clara, Mountain View, and whatnot. But really kind of the experience of going through a period of distress, seeing who all the players were at the time, just what the landscape was, really inspired us 15 years ago at this point to go out and try it on our own.
Thanks, Brian. Picking up on something you just said there, and I'm going to turn it back over to Dave. Dave, can you talk a little bit about Calvera's investment strategy and what sets Calvera apart from other private equity shops?
Yeah, at a high level, as we mentioned, we're multifamily guys. We acquire multifamily property. And our focus and what we've really perfected over time is we're heavily focused on tax efficient cash flow and distributions to investors from the multifamily product that we have. However, we're also buying in high growth markets that we think are going to grow over the next 7 to 10 plus years. Dallas, Research Triangle in North Carolina, Austin, et cetera. And we focus on markets that have high healthcare exposure, high tech exposure. A lot of folks are actually moving from where I am in California, these areas. And so what we're looking to do is deliver tax efficient, distributable cash flow to investors along with appreciation over time from the growth in these markets. What sets us apart, and what we touched on a little bit, is we come from a massive $30 billion real estate firm where we had very heavy institutional training, both on the acquisitions, investor relations, and investment side of things. So as opposed to, and we've heard this from our investors, as opposed to many other companies that raise money from high net worth individuals, the transparency that we show, the reporting that we show to our investor base, the systems that we use and everything else, and kind of the rigorous way we look at deals and underwrite them as if we were a $30 billion company sets us apart from some of the other folks who are raising money from a similar sort of investor base. The other thing I'll touch on is when we buy these multifamily buildings, and it depends on the age of the building and the location of the building, we're highly focused on really dialing in the operations, using our heavy asset management experience to make sure that the right property manager is in place, that we're looking at expenses correctly, that we are all over what the rents should be, and that we are really working with our third-party property managers to operate these things and improve the operations as best as possible. We then also go in and do your typical value add renovations. What we do depends on the specific building, but over time it's varied from obviously rebranding buildings. We're looking at adding technology, sustainability, addressing deferred maintenance, et cetera, things like that. And that's what we've perfected over time, starting with the 7-unit building to now buying 300-unit buildings out of state. Let me turn it over to Brian to see if there's anything he wants to add.
No, that sums it up. Great. Thanks, Dave.
Thanks.
Well, look, everyone loves when things go according to plan, but over the last 12 to 24 months, things have not always gone to plan, I think, for the entire commercial real estate industry. And Brian, my next question is really for you. How would you characterize the market of, I guess you could say, the state of the market for commercial real estate year to date? And where do you think we are right now, just as a pulse?
Sure. Well, some words to describe the current market. I'd say it's stagnant, cautious, in flux. Not a lot of groups feel like they have the all clear to move forward. And investing in multifamily tends to kind of have this herd effect. People don't like to go out and buy when nobody else is buying, even when they inherently know that's the time you should be doing it. Something tells us not to. And we're still in that moment. We've seen deal activity pick up. There's more deals on the market with real sellers, real buyers. It's just difficult to get people to focus. Cap rates don't seem high enough for people to really transact in big numbers, mostly because rents are down or flat in everybody's favorite markets these days. So there's just, on top of that, a negative news cycle for real estate. You see it every day. People are having fun seeing the latest company in trouble.
It's hard. It's hard to find the good news. But If we look at a bright spot, and I would say the poster child, multifamily was the poster child for many, many years. And I know that's a sector you guys are focused on as well. Can you talk about 3 trends that you are excited about in multifamily and maybe a few things that you're a little concerned about?
Well, I think there's 2 big items in particular that to me are both exciting and challenging at the same time. One is a more macro comment on the supply. There's a lot of new apartment supply in most markets today. Places like Austin, Texas are getting historical new deliveries, and it's wreaking havoc on rents. So that's a bad thing for the market right now. It's a good thing for renters. The rents going down. It's making it more affordable for them and for groups like us who are long-term focused. Come 2026 and later, there's not going to be much of new supply, and it's going to swing the other way, and rents are going to go back up. Apartments have had kind of the same level of supply for quite some time, and now it's really taking off. And it's doing what it's supposed to. It's being a governor on the market so that developers don't get ahead of themselves, even though they always do. But I look at supply as both something I'm looking forward to, and it's also kind of a negative at the same time. Same with technology. I mean, there's so many technology improvements for multifamily, and they're all good. There's just, and kind of in my opinion, too many. Our third-party managers, they sign up and enroll our properties in the latest and greatest, and there's just an abundance of technology solutions out there, and we haven't found one that's really all-encompassing and fantastic. Even though I know that's on the horizon, and something I'm personally optimistic for is just the increasing role of technology, not only in the lives of our tenants and their experience at our properties, but also in how we think about how we manage, asset manage our properties, and then just how we evaluate markets and new acquisitions going forward too.
Thanks, Brian. And was there any specific trends that you're a little concerned about in multifamily that you wanted to touch on?
The biggest trend of any concern is just supply. Aside from that, we have in our markets in Minnesota and California in particular, the pandemic really took local regulations, state regulations to a different level. We started in California. We bought rent-controlled buildings for over 10 years now, and we know how it works. But when there's additional regulations put on top of that, eviction moratoria for 3 years, not being able to collect rent, it's just a slippery slope of additional regulation and intervention that we've seen. And even locally in the Twin Cities here, St. Paul enacted a really draconian rent control policy. And Minneapolis has seen all the supply as a result, but that hasn't stopped Minneapolis from wanting to try to enact their own version as well. So regulatory concerns are always near the top of our list, given where we own.
So let's jump to now one of the biggest headlines we keep seeing, which is the topic of distress. I keep hearing this from subscribers and I guess other owners and operators. Everyone seems to be holding out for this second rate cut in the year. What are your thoughts? Do you think we're going to get something from Jerome Powell this year? He's going to bail us out with 1 rate cut, 2 rate cuts? I mean, where is your take on that?
My take is they should have already been cutting. I think inflation's below 3%. It's going down, especially when you strip out the owner's equivalent rent calculation, which is just mind-boggling that it makes up such a large percentage of the data anyway. But your bigger point is stress, and will that bail people out? No, I think it's wishful thinking. We see plenty of deals today where people are selling because of loan maturities, which is fine. That happens every year. But we're still seeing people debating whether or not they buy a new interest rate cap or just taking the temperature of the market and pricing expectations or the expectations are in excess of the loan amounts on deals, but the valuation just is not. Real quickly, ran some quick numbers. If you bought a property at a 3.5 cap, which a lot of people did in 2021 and early 22, with today's cap rates about 5.5, not talking about core A+ deals, you'd need NOI to have grown close to 60% to just break even on value. And at that same 5.5 cap, if you want your value in excess of your loan amount, if you got a 75% bridge loan, you still need NOI to have grown close to 20% since you bought it. That's in an environment in the Sun Belt in particular, which is most exposed to this, where rents are flat, down, and everybody's expenses have grown considerably. So nobody's getting bailed out unless cap rates completely fall. I think the better question is, are people going to have any equity left in those deals bought in 20, 21, and 22? Plenty will. There just won't be much of it. I'm sure in 25, we'll start to see more deals where it's kind of razor thin between loan amount on the deal and what their actual value is.
Yeah, that's something we're hearing across the board as well. And I speak to a lot of operators, and everyone's raising new funds on top of funds, trying to I guess get more debt or equity on their deal. So it's a very challenging market right now. But there are some markets that are doing well. Could you share a little bit about some markets that you're excited about, that you're kind of focused in at Calvera?
Where we're most excited about, and we bought 2 deals there in the last 9 months, is the Dallas-Fort Worth market in particular. We bought a property in Fort Worth about 9 months ago and just closed on a property in Dallas proper a couple of weeks ago. The growth story of Dallas is tremendous. It's not immune to too much supply, but the demand story there is just off the charts, especially for a metro that size. Core markets for us, they're the markets that are being hit hard right now. But as a long-term investor, that's for us a great entry point. Cap rates are higher and rents are down. So Austin, Texas is still very high on my list. Nashville, love North Carolina in particular, the Raleigh-Durham area, Charlotte, Sunbelt. A lot of prime Sunbelt markets still remain affordable, and they're getting a lion's share of population growth. Some other markets we're interested in that actually are doing well right now is finding those markets that are focused on a resurgence of American manufacturing. And a lot of those happen to be in the Midwest. Some are in the Southeast. But a lot of those markets did not get a lot of new supply just because they weren't as interesting to the investor set. And they're seeing positive rent growth now. And they may have good runway because they're still generating new jobs.
Thanks, Brian. And talking a little bit about what's going on, and if you don't mind, in the Sun Belt. I know there's been a lot of supply talk about too much building and oversupply. And you've seen a lot of topics around the Midwest's growing popularity. Do you see an equilibrium happening here shortly in the next 6 to 12 months when demand continues to kind of catch up, or do you think the supply in the South is going to continue to dampen rent growth over the next 6 to 12 months?
It's still going to be a drag on rent growth in the Sun Belt for the next 12 months, probably. When there's just that much supply that have dropped and continued to deliver in these markets, it's just hard to combat that. Austin, it's kind of the poster child right now for too much supply. We're looking at deals out there and rents are down, 10%. It's amazing. Their growth story is not going to change, but affordability is a real issue. What I think helps though is it's kind of the good and bad of interest rates where they're at. If rates stay higher, people aren't going to be able to afford to move into a new single family home, and that's going to continue to put pressure on the rental side and probably drive demand so much so that this supply demand imbalance resolves itself quicker, to your point.
That's a good point. And I just got one more question for you before we turn it back over to Dave here. Let's say we talk in 5 years, what will have changed in the commercial real estate market? What state of the industry do you think we will be at in terms of rates and everything we've just discussed here? Where will we be?
Well, for apartments, I hope that goes back to being a pretty boring asset class like it was 10 years ago. Financing for apartments traditionally has been pretty vanilla. Banks and the agencies, pretty conservative, inflexible, modest leverage lender. That's good for the market. I don't think where interest rates are, the 10-year in particular, that's not a bad thing for apartments. And the hot money, if things go back to being a little boring, the hot money won't be there. I'm hoping for a pretty normal market in the next 5 years. Interest rates help put us there. A lot of supply right now will also help put us there. So my personal prediction is apartment investing in the apartment market goes back to being what it was in the past. A steady, stable, cash flow generating, tax efficient asset where people got successful by being in it for the long term.
Well, for you and I both, I very much hope we're talking in 5 years, and that is the case. I think many investors and firms in your boat would very much like to see that in about 5 years. Dave, I'm going to turn it back over to you. We're going to talk a little bit about fundraising. I understand you guys are on your 4th fund. Dave, can you share a little bit about the latest fund and kind of the performance to date for investors and the strategy there?
Yeah, Brian teed me up nicely there. We spent a lot of time and effort over the last year really trying to find the best, most attractive vehicle fund that we could create for the average investor out there. So what did that mean? As Brian mentioned, we have always admired long-term real estate investors. We think that real estate is an asset class that you invest in over the long term. And that is what we are focusing on in our new Calvera Income and Growth Fund, which is an evergreen fund structured as a fund above a private REIT. As I mentioned earlier, and as Brian mentioned, we're heavily focused and have heard from investors that they want tax efficient cash flow and distributions. So we have added to this fund a number of features that we think provides that, starting with the first acquisition that we just made in Dallas, Texas, at a steep discount that we're very excited about. So we now have the first property in this fund that we just closed on in early June. But back to what I was saying, what are we doing here? So we're trying to provide and will provide regular quarterly distributions from cash flow. We've also built in, as I mentioned, a lot of flexibility. So because this is an evergreen fund, people with 90 days notice, we will be valuing the fund every quarter, and people with 90 days notice can capture the appreciation in the fund by making redemption requests where they can exit the fund at the fund's current value. And that's the way they will capture kind of the appreciation that we are providing if they were choose to exit. That being said, we think people really believe, and we believe in multifamily long term. So the whole goal here is to build a very attractive portfolio of well-located apartments in great markets that will grow over the long term, that we can grow with our investor base. And at the end of the day, there's a number of ways to exit so that everyone does very well. That could range from taking our private real estate investment trust public, which is still not a taxable event. We could sell the portfolio in bulk to a big guy who wants to acquire an attractive portfolio of assets. And that's kind of the story. We've had a lot of excitement from investors about this because it is catering to their needs. People traditionally invested in real estate for the predictable cash flow and the tax benefits. That's what we are providing here, and are really excited about the first acquisition that we just made that should start making distributions here in the third quarter.
Thanks, Dave. And either you or Brian can take this. Can you guys share a little bit more about that acquisition? Because I know we talked about that when we were with Brian here a second ago, but that's pretty exciting. You guys were looking for a while and you finally found something you liked, and you guys closed on that. So tell us a little bit about that acquisition, what you're planning to do with the property, where you see rents going, why you like it. I know Brian talked a little bit about why he liked the Dallas-Fort Worth market, but maybe you could just share what your plans are for that property.
Well, I'll start and then tee it up maybe for some a little bit more of the specifics for Brian. But what I can say and what our investors have appreciated is that we don't put money out just to put money out. We were very patient, waiting for a decline in values in the market and waiting for what we thought was the best opportunity to launch this fund in a market that we were really attracted to, and that would deliver on what we said the fund would deliver on. And so our integrity there and really waiting until we found the right thing was good. All at a high level, being able to buy and acquire this 152 unit building, 2016 construction at around a 30% discount to what someone paid for it new in around 2017 was very exciting to us. The year of construction was exciting to us in that it was a very nice looking property out of the gate. Sure, we'll clean up some deferred maintenance, improve operations. We can push rents, a little bit over time, but we're also making a big bet, as Brian mentioned, onto the Dallas-Fort Worth area. That's exactly why we wanted to buy there. It's also, you can see the path of growth when you go visit it. It's near a Whole Foods. It's in an attractive submarket. The building looks really, really nice, which is fantastic. And again, it distributes cash flow immediately. We are also able to assume a loan at a very attractive interest rate, which allowed us to get positive leverage out of the gate. And the deal still works within our return thresholds or targets in the fund, even with a very conservative refinance assumption in the model. So, we've gotten some good response to this. I've talked to an investor today that loved the idea of the deal, and anybody that invests in an evergreen fund immediately gets access to the cash flow that the fund is generating, which is what anybody could ever want. I'll turn over to Brian to add whatever else you'd like to add.
Yeah, Jordan, quickly, I think that acquisition is indicative of where the market's at right now. People want to upgrade what they've been buying in the past, as do we. So 2016 construction is a lot newer than 1980s, right? A new loan would have been mid to high 5%. We assumed one in the low 4s. So good spread to the cap rate going in, positive leverage, significant positive leverage for us on this deal in particular. Great market, DFW, prime Dallas. These are the type of deals getting done. That's what we waited for. And we're upgrading assets and kind of all characteristics here.
Thanks, Brian. Dave, I'm going to turn it over to you for one last question before we wrap up. In your opinion, why do you think investors are staying on the sidelines just in general? I mean, is there any specific things that you're hearing or seeing that's causing investors to just take a pause other than, just the general things we're seeing in the news?
Yeah, I talk to a lot of accredited investors every day, and just for everybody's information, we started our company and have continued to grow our company by working with accredited investors. It's all been our own networking, referrals, working with marketing teams and platforms such as CRE Daily to grow our investor base. That is what's been our bread and butter. We love our investors. They've been loyal to us, and we have been able to kind of scale that over time. we're now at a point with our track record in this new fund where, in addition to building and continuing to build that accredited investor base, which has treated us so well and been successful for us, we're starting to talk to folks that can write some larger checks, whether that's individual families, whether you want to call them family offices, other groups, to really start to scale our company alongside our existing investor base, which we will continue to grow. To answer your question, I'm hearing a lot of different things. It's very specific to a person's individual situation. I think there's a lot of negative headlines just about real estate in general that some folks see in major publications that can scare folks off. I would argue that means this is the time to dive in right now when everyone else is scared, when values are down. But I get it. It's a psychological thing where that's a scary thing to get off the sidelines. Another thing that comes up all the time is the ability for the first time really in the history of our company to earn, a decent yield on your money by doing absolutely nothing. So we do not tell investors not to do that. We just explain to them that should absolutely be part of their portfolio. But real estate is a different asset class with a different risk reward return threshold, and both belong in your portfolio. But yes, some folks, I don't even want to use the word lazy, but they're doing very well by doing nothing. And so getting over that hurdle of making the transaction and moving the money and everything else, that's a little bit challenging for them at the moment. And then I'd say the last thing that I hear sometimes, particularly from folks, is, look, if you're already in real estate with other operators in other investments or in other partnerships, as we've mentioned, it's probably not, there's a lot of headwinds right now where things are not doing that well. So again, a lot of this comes just back to psychology. Even though it would make sense, and we fully believe, get off the sidelines right now and buy property, well-located, amazing property at a major discount, it's not the easiest psychological hurdle to get over if your other investments in real estate are not performing well, which may or may not be the case. So it takes a little courage, I think, to do it. But as we've tried to convey here, and I talk to investors every day, now is absolutely the time to be entering when you can get a really attractive basis over the long term in a well-located market that also cash flows well.
Yeah, absolutely. We call that mailbox money, Dave. That's mailbox money.
Exactly.
And look, we really appreciate your guys' time. And I think for investors, it's important. And as we've demonstrated here, is like your track record. You guys are on your fourth fund. You guys have known each other basically since college. I think the team that you're investing in is equally as important as the strategy. And I've really been impressed with the entire Calvera team since starting to work with you guys. And being selective on property acquisition is not an easy thing, especially when you're raising money from investors and they're asking when we're going to deploy it. But you guys, you treat it is your own money, right? And that's important. And you have skin in the game. So as we wrap here, I want to say thank you to Dave and to Brian for joining us today for this mid-year kind of market check on the multifamily side of things. And we really appreciate your guys' time and our partnership with Calvera. And if there's any other comments you guys want to say before we wrap up as well, I'll leave it to you guys.
I appreciate you having us on. We've enjoyed the partnership so far and this conversation. And reach out to us if you would like some additional exposure to multifamily.
That exactly. And Brian, thank you as well.
Thanks, Jordan.
All right, guys. Great.
All right, yeah.